Good morning, everybody. Welcome to another Daily Market Report brought to you by Mike York. Today is Tuesday and it's July 31st. Remember, just a reminder, I will be out. Will not be doing any of these videos from tomorrow, the 1st through the 15th. So I should be back by the 16th and I'll continue with the report. So my apologies, I'm just going on vacation, but won't have really much access in and out for internet and stuff like that. So won't be able to, so I'll be taking a little bit of a break. Anyways, let's jump into it because we do got a lot of data to go over today. Today we get we'll start off with the employment cost index for the second quarter. So we had previously written at 8.8% increase. Forecast supposed to be 0.7, so it came in a little under, which is obviously good news because, but the good news out of that is people are getting paid more. We're starting to see part of the cost indexes due to salaries going up. So that's obviously a good sign. And we'll kind of see that here with personal incomes. So across the board, 0.4%. So May went up 0.4%. June continued that same trajectory at 0.4%. So good news, met expectations. Consumer spending, on the other hand, in May it went up 0.5%, and it figured it would be the same trajectory forecast of 0.5%, and it only came in at 0.4%. So people are spending what they are making, basically, is what this is showing us. Now, here's an important one. Here's the personal consumption expenditure, also known as the PCE. This is the Fed's favorite gauge of inflation. So this is the headline number. So in May, it went up 0.2%, and forecast was supposed to be 0.1%, and it came in at 1.1%. They did, for both of these, the core and the PCE, the headline, they revised it for May's numbers by 0.1%. So this brings our from 2.3% down to 2.2%, and from May to June, it remained year over year remained unchanged at 2.2%. Now the core, we had 0.2% increase in May. Forecast supposed to be 0.1, which it did, and it came in at met expectations. So this went from year over year of 2% down to 1.9%, and also remained unchanged from May to June at 1.9%, which is obviously good news because it's keeping inflation still in check. It's not getting out of control. So this is important here, and you'll see why the bond market didn't take off. You'll kind of see a little bit with how the bond market will react to it because inflation is its biggest enemy here. So Case-Shiller home price for the month of May, it shows basically unchanged here. It went from 6.4 in April to 6.4 in May, so it remained unchanged. Still a very good number here. The media likes to make this sound like, like the sky is falling, but the reality is 6.4% appreciation. That's still a pretty high number, and obviously doing very well for those who are homeowners, and obviously they like to see more equity built in their homes. Now, Chicago PMI, this is the manufacturing in the Chicago region here, and for the month of July. So, in anything above 50 on this index is considered expansion, which you can see we're at 64.1 in the month of June. In July, it finished up at 65.5. So, manufacturing, pretty much all the regions where we've been seeing it jumped up here. So, we had earlier in the month, we saw New York, and we saw Philadelphia going up, and now we're seeing Chicago going up pretty good levels here. So, good news in the manufacturing that is coming rebounding a bit and at pretty good levels here. Consumer confidence, when you think it can't go up any further, as you can see here, it went from 127.1 when the forecast was supposed to be kind of in that same range. Well, actually went up to 127.4 in July here. So good numbers over here as well. Let's jump ahead here to the headline news. Stock market is up. It's kind of shaken off after a few days of losses here. We've been in the broader market. We're getting some great economic corporate earnings reports coming out here, but the tech sector's been kind of the one that's really been the one that's the bull, so to speak. It's one that's really kind of boosting the rest of the markets up there. And because Facebook and Twitter came in with disappointing numbers, it basically brought everybody else down with it. Now tonight, after the market closes, we'll get a glimpse of Apple. So if Apple shows good news, it'll probably the stock market will expect it to take off tomorrow once they're able to reopen, and you'll see some probably good more signs in the stock market taking off again. So of course, as I mentioned, second quarter earnings seasons here. Now today we start the two-day FOMC meeting. The Fed will be meeting today, and then tomorrow we'll be giving an announcement, usually by 11 o'clock Pacific Standard Time. Now, they are not expected to give a rate hike at this meeting here. That will be expected next month, or sorry, not next month, next meeting, which will be in September. They're expected to raise it by 0.25%. but they will be listening to see any the statement as to if there's any changes in there, if they're expecting continued of 2 more rate hikes this year, or probably look at the dot plot for next year. So far, before it was definitely 3 this year. Now it looks like it's greater chances of 4, and then they expected about 3 rate hikes for next year. But again, that could change too. And then see what their statement says about any of the tariff talk or the economic outlook from there. So they're going to be looking at that pretty heavily tomorrow. So be prepared for some volatility. Here's the bond market. Bond market's doing all right. We kind of test the market back and forth here. We're currently up about 9 basis points. It's kind of helping us out here. As you can see, we're in a sold position, so we could definitely see some possible improvement here. But again, we're going to see a triple layer of resistance here coming up here, so it's going to be pretty hard to break above that. But once we get above this, it will kind of be a neutral territory, and it's could go in either direction, so to speak. Same thing here, the 10-year Treasury. We're kind of an open area. It's kind of oversold area here. Can bring us down, but we got a lot of room in either way here, where we got floor support here, and we got a ceiling right up here. And even though we got a ceiling here, this is probably a little bit stronger ceiling, and so my feeling is it could break above this way. So just be cautious here. Again, if you guys are floating interest rates out there, may want to get very just be a little cautious as to putting the finger on the trigger, so to speak. All right, because it could change very quickly, and for the most part, it could go to the worst. Where bond market goes down further, which will bring up rates. So just be a little cautious out there if you are out there with a refinance or a purchase and not yet locked in. All right, so that wraps things up. Again, I won't see you guys for about 2 weeks, and I won't be posting on Twitter either. At least economic stuff. So, but today I will. If you guys, in the meantime, want to follow me at Twitter at Mike Bjork, I'd love to see you guys there. Otherwise, I'll see you guys when I get back on the 16th. All right, have a great day and enjoy your summer. And thanks for watching. Bye bye.